Welcome back to Alpha Recap, your quick hit on what moved markets after the close. We've got governance drama in big private AI, a shock in pharma, and a pretty split consumer picture. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. Markets closed mixed today after a lot of idiosyncratic headlines. Some big name beats, some real surprises.
Let's just run the headlines. AstraZeneca had a late-stage trial miss and the stock slid. Double, about 9%, which was the clearest immediate market reaction.
That was a heavy move. Clinical binary risk showed up in full force.
Meanwhile, Anthropic added former Fed Chair Ben Bernanke to its independent trust, a reputational governance signal that analysts flagged as meaningful for private AI valuations.
Right, and at the opposite pole, Apollo put out a scenario warning that if AI commercialization slows, it could materially raise recession risk. Big picture macro caveats there.
On the corporate beat, Levi Strauss topped expectations, raised guidance, and boosted its dividend. Net revenues were up about 8% and organic sales were up about 6%.
PepsiCo beat on revenue, but warned about tighter consumer budgets. And 7-Eleven disclosed a $349 million gasoline-related windfall. So a real mix of structural and one-off effects today.
So, what really stands out here is the tension between governance improvements in AI and real cash flow timing risk.
Exactly. Anthropic's hire is a governance win. Analysts say it lowers perceived governance risk. But governance doesn't create revenue. Apollo's note reminds us that delayed monetization has macro implications.
Let's break that down in plain terms. Governance is about trust and oversight. If a respected public official joins an independent trust, counterparties feel safer and may accept lower risk premia on valuations.
And monetization timing is about cash hitting the P&L. If revenue comes later than expected, margins and profitability compress, which can hit hyperscalers and the whole cloud profit pool. That's how a technology timeline can feed into macro growth.
Right. So one side is sentiment and required returns, the other is actual dollars. Analysts are debating how much a governance move can offset a delayed revenue stream.
And there's a real market implication. If governance reduces the private company discount, valuations might stay elevated temporarily. But if monetization disappoints, multiples could still reprice hard.
Switching gears to healthcare, that AstraZeneca drop is a textbook example of binary trial risk.
Big move.
When a late-stage trial fails, you don't just lose one product's value. You reprice the optionality baked into a drug maker's market cap. For some firms, a meaningful slice of value is future pipeline hope.
Analysts pointed to Amgen as an example of a name showing relative strength. Over the last 6 months, Amgen was up about 12%, versus the S&P being up about 7 to 8%. But AstraZeneca's drop shows how volatile that sector can be.
Short reactions? No way.
Yeah, that tracks.
On consumer, we saw clear divergence. Levi's looked resilient. Revenue up about 8%, organic up about 6%, margin improvement and a dividend increase. That's brand strength showing through.
Meanwhile, PepsiCo's beat was offset by commentary about consumers tightening wallets. That suggests staples could face pricing and volume pressure if people trade down.
So the takeaway there is not a simple cyclical call. It's micro-dispersion. Some discretionary brands with pricing power can outperform staples that rely on volume.
Exactly. Analysts are saying to look at company-level indicators, same-store sales, organic revenue trends, rather than broad sector labels.
Another theme worth pulling out: legal and regulatory risk. The New York Attorney General filed a lawsuit alleging PFAS harms against manufacturers, including some big chemical names.
That brings remediation costs and long-dated liabilities into focus. For industrials and chemicals, these are not just headline risks. They can meaningfully drag on free cash flow and valuations over time.
Short reaction, that matters.
And don't forget the one-off cash story. 7-Eleven's $349 million gasoline windfall boosted cash flows this quarter. But analysts flagged it as a short-term commodity effect, not structural margin improvement.
We should unpack the conflicting market views, because that's driving volatility. ClearBridge is on one side thinking about adding risk after a strong second quarter. The S&P gained about 15% in Q2. while Apollo is warning about the downside if AI monetization lags.
So the active debate. Do you lean into the late cycle rally or hedge because of a possible technology execution miss that spills into the macro? Tactical managers are split.
Analysts suggest scenario stress tests, model the different AI revenue timing outcomes, and see how hyperscaler margins and cloud profit pools change. That's more useful than a blanket bullish or bearish call.
Totally. Also important, separate governance improvements from monetization risk. A famous name joining a trust helps sentiment, but it doesn't change revenue curves or token economics.
Let's give listeners some concrete things analysts are watching. 1. Run scenario analyses that vary AI revenue timing and margin outcomes. 2. Quantify biotech optionality exposure in portfolios and stress single asset event risk. 3. Model remediation costs for PFAS and similar litigation.
And 4. On consumer, track granular metrics like same-store sales and organic growth rather than relying on headline consumer sentiment. That's where the dispersion shows up.
We should also call out who might care about what. Long-term growth investors, the structural themes around AI remain compelling, but analysts say to plan for longer monetization timelines and higher volatility.
Income and value investors. Levi's dividend move and Amgen's strength were highlighted as income-friendly signals, while chemicals with litigation risk require deeper balance sheet work.
Event-driven traders and quant funds expect continued volatility from binary readouts like clinical trials and trading opportunities around those shocks.
Tactical managers were told to consider scenario hedges rather than broad allocation shifts. Stress testing, dynamic hedges, that kind of approach.
A quick deeper context note, AstraZeneca's roughly 9% drop wasn't just a knee-jerk reaction. It forced a reassessment of R&D multiples and discount rates used to value future cash flows. Those math adjustments can be big on a multi-billion-dollar company.
And on Anthropic, hiring Ben Bernanke is unusual. It's a signal that private AI firms are trying to reduce governance friction and improve deal terms with investors and partners. But again, reputational, not a cash flow event.
Apollo's analysis ties it all together. Slower AI revenue growth could compress hyperscaler margins, reduce capital multipliers, and potentially slow GDP growth. That's the channel from tech disappointments to macro slowdown.
All right, quick check-in. We've dropped a lot of concepts. Any confusion on monetization versus governance we should clarify?
Good point. In simple terms, governance affects the price people are willing to pay for a company today. Monetization affects the actual dollars a company earns in the future. Lower governance risk can support valuation, but if the future dollars don't arrive, those valuations can still fall.
Short reaction. Got it.
We should reiterate the disclosure. Everything we discussed is informational. Analysts note this isn't personalized investment advice, and we're not telling anyone to buy, sell, or hold any security.
Right. Use the analysis to inform your own modeling, scenario work, and risk controls.
Okay, let's close with 3 clear takeaways. 1. Governance moves in private AI matter for sentiment, but they don't replace revenue realities. 2. Biotech and pharma remain binary. Single trial outcomes can reprice large caps quickly. 3. Consumer is divergent. Brand-led discretionary strength coexists with staples caution.
And a bonus tactical point. Stress test AI timelines and model litigation liabilities explicitly if you have exposure to chemicals or industrials.
Final quick reactions. Honestly, I was a bit surprised by how sharp the AstraZeneca move was.
Yeah, that was a wake-up call for anyone underestimating single event risk.
That wraps our recap for today. If you have questions about anything we covered, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening. We'll be back after the next close with more analysis. Remember, use these insights to frame scenarios, not as specific advice.
See you next time on Alpha Recap.